forgot to turn this audio on. Testing? No.
Is that black tea with milk?
It's chai. Yeah. It's stash chai. It's I think it's the same chai they sell at the front. But if you get it from Amazon, you get 100 packets for like $50.
I've tried making my own chai lattes at home and it's never as good.
To really make chai, you got to make it on a stove with throw in the cardamom and it's made with milk. It's not made with water. It's actually very rich. So if you ever travel to India, they used to, if you went on trains, they would serve the chai in clay pots. So when you were finished, you just smashed it because that way you didn't have to worry about hygiene or. They didn't even turn the volume on. They haven't even turned the volume on. For some reason, they forgot the audio, so none of the mics are working, if you could tell them. You can try it. Speak really. They'll have to come and turn the audio on. I didn't get to this stuff anymore. We're waiting for the mics. Can you hear me? No? No. For some reason, they forgot to turn the audio on to either mic, so nothing is working, and I'm not going to scream for 80 minutes. I'll have no voice left, so they should be here in a minute or two. Oh, it's working now, right? Okay, you can use it. This is working too.
Hi everyone, my name is Alice. I wanted to make a quick announcement before class today. I'm one of the vice presidents of the Management Consulting Association and we're hosting our annual case competition. So wanted to encourage anyone who has any experience casing or is interested in winning a $500 Amazon gift card to submit a case. You'll get an email about it later today. Cases are due May 1st and the top 3 winners will get, again, $500 for Amazon. So pretty sweet reward. Highly encourage you to consider submitting a case. Thanks.
Take care. So the end is near. It's only 3 weeks left of class, and then it's finals week, so which is good news and bad news. Good news is the end is near. The bad news is the end is near. So either way, you got to get your projects going if you haven't been working on them. But you had a chance this weekend, right? You all did the optimal debt ratio for your companies. Yeah. Okay. Good. Okay. So that's what I'm going to start with today. If you've done the optimal debt ratios, in the next 20 minutes, you can actually do your project while we're doing what we're doing in class. So we talked about coming up with an optimal debt ratio using a cost to capital approach, an enhanced cost to capital approach, an APV approach, looking at what everybody else in the sector is doing, where you're in the life cycle. Whatever, use all of them. Make a convergent decision. This is what my optimal is. And now you have a choice to make. Your actual debt ratios out there, you've come up with an optimal. One of 3 things I said is going to be true. Either your company is right or close to its optimal, in which case what should you do? Follow the Hippocratic Oath. Do no harm. Don't feel the urge to tell a company to do something when it doesn't have to do something. But let's take the 2 other scenarios. Your company could have too little debt or too much debt. If you're going to have a problem, which one should you have? It's a much more pleasant problem to have too little debt than too much debt. So let's take that problem first. So if your company is under levered, if it has too little debt, the first question you need to ask yourself is, Does being underlevered make me the potential target of a takeover? So let me start with that question. Why would having too little debt make you potentially the target of a takeover? Sam? It'll be, you made the acquirer's job really easy, right? To do your acquisition, what does he have to do? He basically can borrow money using your assets to essentially take you over. So if you're underlevered, you've made acquisition simple. In fact, I'll give you the analogy that will bring this home, because I think it's in a sense tricky to think about why a company being underlevered would make it a target of a takeover. Let's make it much more personal. Let's suppose you buy a house anywhere in the tri-state area. It's probably going to cost you $1 million plus. And unless you're a drug dealer, you're not paying for it with cash, you're probably going to borrow much of the money. Okay? So let's say you borrow 75%, you buy the house, and then you're really frugal. For the next 5 years, you pay down your principal. So at the end of the 5th year, you own the only all-equity financed house in your entire neighborhood. You decide to have a mortgage burning party. Have you heard of these? In the old days, when people used to live in the same house for 30 years, the day they made their last mortgage payment, they would have a big party. They'd have coffee cake and orange juice and coffee and maybe even alcohol. Invite all the neighbors over, and they'd physically burn the mortgage papers. Once in a while, they'd burn the house down with it, but that was kind of a bad side effect. So you decide to have a safe mortgage burning party, which means that you're going to invite the local firemen over as well, so they all show up at your house. And your neighbor Bob, who's never liked you, also shows up. Why? It's free food. He's never liked you. He's lived next to you for 15 years. He doesn't like the shrubs you picked. He doesn't like the way you cut your lawn. He's never liked your kids. But he shows up anyway. And while he's eating your coffee cake and drinking your orange juice, he's plotting his revenge. So after the party, he goes to the local neighborhood bank. He says, there's this house in my neighborhood. It's $1 million. It's worth $1 million. It's all equity funded. Will you lend me $800,000 against that house? This is where the analogy kind of breaks down, right? You go to a bank and try to borrow on your neighbor's house. What's the response you're probably going to get? It's not your house. You can't borrow. But let's say this is your friendly neighborhood banker. He advances $800,000 to Bob, who now proceeds to do a hostile acquisition of your house. Again, I'm not quite sure how this works. He approaches your kids and says, hey, you know what? You want your own floor? Just sell your share of the house. He gets 51% of the house and throws you out of the house. Thank God this can't happen with a house. But let's make this a $1 billion company that could have $600 million in debt. But you're the CEO and you hate borrowing money. So you've run this company as an all-equity funded, publicly traded company. I see your company. I see you can borrow $600,000. I go to the friendly neighborhood bank and I try to borrow $600,000 on your company. Odds are I'm going to run into the same issue I ran into with the house. And until the early 1980s, that was the end of the game. But what happened in the early 1980s that allowed me to break away from the banker? It was, no, this was before leveraged bonds. Drexel Burnham and the start of the junk bond. People think about junk bonds as beginning in the early 80s. Junk bonds have always been with us, but the way a bond became a junk bond was it started investment grade and it slid. So you started at AA, AAA, and then you slid over time. What was different about the 1980s was Mike Milken allowed for an original issue junk bond market. Until then, if you were double B or single B rated, you couldn't issue bonds. People didn't buy it. He said, not a problem. If you give a high enough coupon rate, people will buy your bond. See the opening you've given me? I have a $1 billion company. I have nothing to back up this loan. I issue the loan with a really high interest rate. And why do you lend to me? Because I have a track record of doing this in the past. So I borrow $600,000 using your assets as the basis implicitly. I'd pay a very high interest rate because people can see I don't own your assets. Then I proceed to acquire a company. You're a very conservative CEO, right? So in addition to not borrowing money, what have you very conveniently accumulated in the company for me? A $250 million cash. It can't get any sweeter than this. Here's what I did. I borrowed $600 million using your assets implicitly as a base. Now I'm using your cash to pay off the debt I took using your... You've made my life really simple. So if you're under-levered, the first question I have to ask is, are you under threat of a takeover? And what are some of the things I might want to look at to make that judgment? What if I told you Microsoft is under-levered? Is it under threat of takeover? Why not? One is owned, but even before ownership, you have a 300, 400, 500 billion, Microsoft was $700 billion company. That's going to be a lot of money to some. So one is, I'm going to look at the size of the company. Very large companies are potentially more difficult, not impossible, more difficult to take over. Second is the ownership structure, which is, if you have Bill Gates and Steve Ballmer owning 20% of the stock, it gets more difficult to get to 51% because they're not going to partake in your hostile takeover. So I'm going to look at the size of your company in terms of market cap. I'm going to look at who owns the company. What else might I want to look at? I'm sorry? And what would the peer group tell me? And that's a good point. The more other companies get taken over, the more you worry about this happening to you. So you're saying if this is a sector where takeovers are common, I should be more worried. Anything else? If you have voting shares, non-voting shares, poison pills, all that corporate governance section comes in here, right? Because in the corporate governance section, I asked you about how is this company structured. And there's one final point you might want to look at. Remember when I gave you the classic target firm in a hostile takeover? I know you don't, but it was like session 2. I showed you a graph of what the typical firm in a whose target in a hostile takeover looks like. Is it a well-managed or a badly managed firm? It's a badly managed firm, and in terms of stock performance, it's usually a company that's underperformed the sector. Because here's what every hostile acquisition is. It's a fight between two sides. On one side is the activist investor, the acquirer, and the other side is the management of the company. And for once in your life, you as stockholders get to decide who to go with. So if you listen to the acquirer, what does he tell you? He says, don't listen, the managers have not taken good care of you. We're going to do much better with your company. And the manager says, don't trust those acquirers. They're going to ruin the company. And you get to decide who to trust. Let me tip the scales. Let's say your stock is down 70% over the last 5 years. Who are you more inclined to trust? You're probably going to say, I'll take the acquirer because I know exactly what you've done to me over the last 5 years. Is there something we've already measured to capture how well or badly your stock has done? Remember the Jensen's alpha and the excess returns? It all comes together. If you're a company with a negative Jensen's alpha, you underperform the market, you have a negative excess return, you're earning less than your cost of capital, you're in a sense set up to be potentially the target of a takeover. So it's not like you have to wait for a Wall Street Journal article that says you're the target of a takeover. You can, looking at your company's characteristics, make that judgment. And if you're the target of a takeover, you've got to do something quickly. You can't wait 5 years to fix your debt ratio. You've got to bring your debt ratio up quickly. And to bring your debt ratio up quickly, you've got to do a recapitalization, which means you can't mess with the asset side. You can't go out and take projects. You've got to do this overnight. And there are two ways you can bring your debt ratio up quickly. One is to borrow money and buy back stock or pay a dividend. Because the borrowing money would raise the debt. The buying back stock or paying a dividend would reduce equity. Overnight, you can make your debt ratio go from 10 to 50%. And if you're a really small company, you might actually be able to pull off what's called a debt for equity swap, where you approach equity investors in your company who are planning to sell anyway and offer them corporate bonds of equivalent value in your company. It might or might not work, but for a small company, you might pull it off. So if you're under threat of a takeover, you've got to move quickly. You have to do a recapitalization. But if you're not the target of a takeover, you have the luxury of time. And one thing to remember about debt ratios changing quickly, it's like putting a shock to the system. So if you raise the debt ratio quickly, companies become much more difficult to manage. So if you have the luxury of time, you'd like to spread the change in the debt ratio over time. So if you have the luxury of time, I'm going to ask you, do you have good projects? And I'm not going to waste the time asking managers, do you have good projects? What are they going to tell me? Yes, I have lots of good projects. So you know what I'm going to look at? I'm going to look at your track record. And here again, something we've already done comes into play. When we looked at your return on invested capital as a company and compared to the cost of capital, we got a measure, a rough measure, of whether your company was earning more or less than its cost of capital. So if you're a company that has had a history of taking projects that earn more than the cost of capital, and you say, yes, we have good projects, I'm going to say, okay. This is a double whammy. You will take advantage of both trends working in your favor. Go out and borrow money and take those good projects, and you will always get a bigger increase in value than just recapitalizing. Why? What's the definition of a good project that we used in the investment analysis section? It comes with a positive net present value. And when you take a project with a positive net present value, your value as a company will increase by that net present value. So if you have good projects and you have excess debt capacity and you have time as your ally, you should borrow money over time and take those good projects, and over time your debt ratio will go up, and you'll also get the added benefit of these good projects. So you can already see with debt ratio, everything starts to converge. Corporate governance, investment analysis, hurdle rates, they all come into being. If you don't have good projects and you still have the luxury of time, then you've got to bring your debt ratio up over time by paying more dividends or buying back stock over time. But now you're going to stretch it out over time, which is also going to give you the advantage of revisiting what your optimal is every year to make sure you're moving in the right direction. So let's summarize. If you're underlevered, the question I'm going to start with is, are you the potential target of a hostile takeover? If the answer is no, I have the luxury of time. If the answer is yes, I've got to do something quickly. If the answer is no, then I'm going to follow up and say, do you have good investments? If you have good investments, I'm going to encourage you to borrow money and take those good investments. If you don't, then dividends and buybacks become your mechanism over time to reduce your equity. Because you don't need additional debt. What are you going to do with it? You're just bringing your equity down and hoping your debt ratio rises to what the optimal is. So that is if you're underlevered. As I said, if you're going to have a problem, that's a nicer problem to have. If you're overlevered, I'm going to ask you a question about urgency again. And this time, I'm not worried about takeovers. If you have too much debt, what am I worried about? Will you make it? Are you under threat of bankruptcy? And what might be some of the things I look at to make that judgment? One is if you're already having a rating, I can look at your rating. If you're triple C, I don't have to sit there and intellectually struggle with this. If you're triple C rated, you are under threat of bankruptcy. I've got to do something quickly. But if you're not triple C rated or you don't have a rating, then I have to look at things like your interest coverage ratio. Let's face it. If you're under threat of bankruptcy, or if you have a client or a company, you will know. You know how you'll know? Every part of the company will reflect that fear. You walk into that front lobby, there's nobody sitting at the front desk. Remember that stock price that used to run in a ticker over there? That's been turned off because it's too depressing. Because how many times can you keep showing zero before you say, okay, zero is zero. It can't get any lower than that. You go into the toilet, you ask for coffee. They say, bring your own coffee. We have nothing here. It's like going into a morgue. When you go into a company that is truly worried about making it. And if you're under threat of bankruptcy, again, you got to do something quickly. And here it becomes much more challenging. Mechanically saying, what's so difficult? I just have to bring the equity up and bring the debt down. But every path you choose will come with prompts. So give me some of the things you read about that companies do when they're in trouble to bring their debt ratio down. What could I do? One is sell assets. Let's go down that path. I could sell assets and pay down debt. What's the problem with that? Does everybody know I'm in trouble? Yes, and I put out this plan. I want to sell assets to bring down. My bargaining power is just shot to hell, right? I'm sitting across a table from somebody who says, let's take the last zero off. I don't feel like paying it. So try to sell assets. The discount you have to accept on value is huge. So that's going to be tough to do. How about issuing equity? Because that could bring the equity up. The only problem is you try to issue shares. What's a news story that's going to run in the Wall Street Journal the next day? Basket case company announces plan. It's like MoviePass trying to issue shares. There is no price at which I will buy those shares, but it'll be 0.00. So raising equity becomes difficult because everybody knows you're in trouble. So trying to sell assets doesn't work. Raising equity doesn't work. You know what the only thing that might work is? What's the only thing you're working for you? You could go bankrupt. And what happens when you go bankrupt? The lawyers will take it all. So here's what you do. You go to the people you owe money to and say, you know what, I have a great deal for you. These 1-year loans, can you make them 10-year loans? That 15% interest rate, can you make it a 1.5% interest rate? You say, why would they accept? What choice do they have? It's like negotiating with a guy who owes you money. He's got a gun to his head. Accept my terms or I'll blow my brains out. Your bargaining power is greatest just before you declare bankruptcy. That's why we negotiate. I mean, let's face it, Latin America has given us this template on what to do when you're on the verge of default. There's actually this amazing story. I thought it was actually fake until I read through and it turned out to be true. About Latin American country. I don't want to insult the wrong one because they've all gone defaulted at some point in time. It's one of those. And it was in the late 1800s. They'd borrowed money from a French bank. Why? Because the French bank felt there was a lot of potential in Latin America. And it turns out they couldn't pay the loan. So at the time the loan comes due, the Latin American country sends a missive to the French bank saying, you know, guys, we can't make the interest payments we were supposed to, but we can pay with guano. You know what guano is? It's bird droppings. So we have a lot of bird droppings. They're great fertilizers. We can put them on ships and send them to you. The first reaction the French bank had, we don't take guano, we need cash. And they said, it's guano or nothing. And they said, we'll take the guano. The Greeks should have tried this. Olive oil, you know, how about olive oil instead of cash, right? You don't have to be but desperation can lead to much better deals for you. I know it sounds unethical and immoral, but if you're on the verge of bankruptcy, this might be the only trick you can pull off, is saying, no, agree to my terms. But you can see already why it's so difficult to get out of an over-levered problem if you're on the brink of bankruptcy. Hopefully, very few of your companies are on that brink. Because if you're not on the brink, then again, you get the luxury of time. And if you have the luxury of time, ask yourself the same question you asked when you had too little debt. Do I have good projects? Because if you have good projects, here's what you're going to try to do. You're going to try to redirect your equity into those projects, and you don't even have to issue shares. All you have to do is stop paying dividends. It strikes me as when companies that are in deep trouble continue to pay dividends, I've never understood it. Take that money, put it back into projects. Over time, what's going to happen? These are good projects. Your equity will increase. Your debt problem will go away without you having to pay down the debt because your equity expands to cover it. But that's if you have the luxury of time. So if you're over-levered, again, start with the question, how quickly do I need to fix the problem? And if the problem does not have to be fixed quickly, then decide, should I take projects? And if you don't have projects, then of course you got to use your retained earnings to essentially pay down the debt over time to bring your debt ratio down. So let me try this on my company. As I do this on my company, start thinking about yours, because you should already have the pieces in place to do what I'm going to do for Disney. It is an under-levered company because its actual debt ratio is about 11.6%, and with the different approaches I came up with 30 to 4, so it's under-levered. Is the firm a takeover target? In 2013, I said no for a couple of reasons. One is, at $130 billion, it's a pretty large company. It's not a Microsoft at a $600 billion, but $130 billion is a lot of money. Second, it's also a company that has done well. Remember the Jensen's alpha I computed was 9% a year for the previous 5 years. So given that it had been doing well for 5 years and was a $130 billion company, I said, probably not the target of a takeover. And since Disney's been a company I've done in every edition of the book, it's amazing how my views of whether it's a takeover target have shifted depending on the edition. In 1997, it was doing well. I said, not a takeover target. It's a $100 billion company. In those days, $100 billion was a big company. 2003, its market cap had been halved. Why? Because Michael Eisner had gone a little crazy with the Cap Cities acquisition. Nobody liked the CEO. By 2000, I actually bought Disney shares in 97 because I wanted to feel the pain. And for the next few years, I felt a lot of pain. By 2001, my vision of a good day would be to open up the Wall Street Journal and see a headline, eToys announces hostile acquisition of Disney, because you almost wanted people to shake the company up. By 2002, it looked like a potential takeover target. And if you remember, Comcast actually made that ill-fated hostile acquisition bid for Disney in 2003. By 2007, it had gone. So basically, over time, you can see companies shifting from being. So if it's not, in 2013, my conclusion was it was not a takeover target. And then I said, does it have good projects? And if you remember, the return on capital I computed for Disney was way above its cost of capital. I think it was 12.6% versus 8.1%. And it was clear that Disney had big plans. It was building a Shanghai theme park already, wanted to expand ESPN into a streaming service. It didn't have the Disney streaming in mind still, lots of plans. So I said, given that you have excess debt capacity and you have all these plans to invest, and since your projects are good projects, my conclusion in 2013 is they should take good projects with the debt. That too can change in a heartbeat, right? Because if Disney does an acquisition of Netflix, in fact, this News Corp, not the News Corp, but the Fox, the 20th Century acquisition, make me, as a Disney investor, it does not make me particularly confident about their capacity to take good projects, because you pay $81 billion. I think that's what the final price tag is. That's a huge investment. So we're going to all be watching how that plays out, because if that plays out badly, Disney will have lost flexibility for pretty much a generation. That was a huge bet on a single acquisition, and it's going to show up in lots of different ways. So take your company, pass it through if it's under-levered or over-levered. Yeah. One of the things I think that's, if your company is under-levered, if it's under takeover threat, one of the ways you can tell that you're under threat of a takeover is when the management of this company starts talking about how much they care about shareholders. That's usually a dead giveaway. They're terrified. I still remember in the late 90s, Telecom Italia was one of the first big hostile acquisitions in Europe, because until then the Europeans thought that this hostile acquisition thing was an Anglo-Saxon barbarian action. You would never approach, you'd get onto the continent. I mean, civilized Europeans wouldn't go around acquiring other companies when they didn't want to be acquired. So Telecom Italia gets acquired in a hostile acquisition. It shakes top management across Europe. So there's this panel discussion in, I think, Europe somewhere, maybe in Switzerland. And I was the master of ceremonies, which is a role I hate to play because you can't say a thing. You just introduce people who sit there, and while they say stupid things, you've got to keep a straight face saying, okay, that was okay, that was okay. So I was sitting next to the CEO of Siemens, and he gets up and he says, at Siemens, we care deeply about shareholders. I almost fell out of my chair. I mean, this is a company that's treated shareholders like mosquitoes for a century, saying, SWAT, get out of there, you got your dividend, don't bother me. Okay? I mean, listening to this guy talk about how much he cared about shareholders, I had the same sensation I had when I heard Madonna sing Like a Virgin. To which my response is, how would you know? What is the deeply repressed memory you're pulling up? I mean, these are share managers who've never cared about their shareholders over their entire lifetime. All of a sudden they wake up and say, oh my God, I care about shareholders. So watch out for CEOs who essentially start talking about shareholders. Because Michael Eisner did the same thing in 2004. He says, I care about shareholders. It's all about shareholder wealth maximization. Okay? So take your company, look at the numbers, but also look at the outside signs, because it's amazing how much they will start reflecting when there's fear involved in the company. So once you've come up with the optimal, as I hope many of you will already have or will soon, make that choice first. Do I have to move quickly, or do I have the luxury of time? And that's going to depend on whether you're under immediate threat, either of a takeover if you're under-levered, or bankruptcy if you're over-levered. Then follow by saying, how should I get to my optimal? Should I just change the mix of debt and equity, recapitalize, or should I be borrowing money or issuing equity to take good projects? And that's going to depend on what you earlier came up with in terms of, does my company have good projects? Everything is tied up to what you've already found. So this becomes part of a net you're weaving for your company where everything's connected. Any questions on? Yeah, go ahead, Sam.
This is also the benefit of management, though, right? I mean, if you have a company that's under-levered, there is good projects, but you might be taking over because management is performing poorly. Rapidly levering up is the detriment to shareholders.
Now, back up. So you have a company that is under-levered. So what's the rest of the story? It has bad management?
Well, it's a takeover target.
It's a takeover target, okay. So you're saying why make the management borrow the money when let the acquirer borrow the money and take over the companies?
Let the management try good projects. Why rush to borrow debt and throw it back to shareholders?
Because they might never get a chance to buy the good project. But what's the acquirer going to do? He's going to offer a premium today over the stock price, right? So, you know.
It's the benefit of shareholders versus just not right now, right?
Well, I think that's true. The shareholders benefit either way. But this way, at least, the managers get a chance. I'm going to give them, it's like a last chance. Do you want to do the right thing, or do you want to hold on to your thoughts about debt always being bad? You'd be amazed how often managers will refuse to do the right thing because these managers have a history of thinking they've been right all the way through. But I want to give them at least that, hey, you know, I'll give you one last chance. Right? Because if you can lever up, you're essentially also going to commit to not taking projects because that debt is going to come with those handcuffs on you. So that'll be a good thing given your history. And many managers will choose not to take that path. Any other questions? So yes, go ahead.
Does having a high dividend payout also block hostile takeovers?
Well, remember, dividends affect equity by lowering equity. So essentially, think about the mechanics. If you have lots of dividends, what you're doing is lowering the market value of your equity because the day of your ex-dividend, your stock price drops. So a practice of paying high dividends, if you're under-levered, will kind of keep your debt ratio up. So if the only thing you're worried about is being under-levered, paying more in dividends will reduce that problem. But it doesn't hide your other problems. You're taking bad projects and so there's other stuff that might cause you to still be a target. But the dividends do affect your debt ratio by lowering the market value of your equity.
Well, I'm talking about acting as a deterrent for anybody wanting to acquire in the sense that they would then have to...
But the problem with dividends is if you want to go from 10% to 40% debt, traditional dividends won't do it quickly, right? You almost have to pay a special dividend that's huge. And the problem with special dividends that are huge is people receiving the dividends will have tax consequences. That's why when you have a lot of debt movement, so if you're moving from 10 to 15, dividends might do the trick. 10 to 40, you almost always have to do a buyback simply because it's more tax advantageous to the investors in your company. Yeah. But dividends and buybacks have the same effect. They both lower the value of your equity. So the mechanics of changing a debt ratio to decrease the debt ratio, here's what you can do. You can sell, did I do the mechanic? Yeah. You can sell assets and use the cash to pay down debt, or you can sell assets to pay if you want to increase the debt ratio, sell assets to buy back stock or pay special dividends. If you want to decrease the debt ratio, you can issue new stock and retire debt, or borrow money. So in a sense, if you want to move your debt ratio quickly, there are ways to do it, whether you're under-levered or over-levered. It just turns out to be easier to do it when you're under-levered because your actions don't get pushed back. Whereas if you're over-levered and you're trying to sell assets to pay down your debt, I mean, that's a much tougher task to pull off. And if you're going to change it gradually over time, the mechanics are easy, but working through the process is a little messy. And here's why. Okay? Remember, you can do both dividends and buybacks will reduce equity over time. So you can increase dividends and kind of keep them at a higher level for the next 5 years. Or you can announce a buyback that's spread out over 5 or 10 years. Right? The complication, though, if you ask me, so let's say you want to get to a 40% debt ratio. Right now, if you're a $1 billion company, to get to a 40% debt ratio, I'm going to say you've got to get $400 million in debt. But if you want to get to a 40% debt ratio 5 years from now, and you ask me how much dollar debt will I need? The answer is going to be much higher than 400 million. Here's why. I mean, remember that when you track a company over time, if it's fairly priced today, the value of the equity should go up by roughly the price appreciation portion of your expected return. Remember we came up with an expected return of 9.95% for Disney? And I said some of that is for dividends, maybe 2%, the rest is for price appreciation. So if Disney is fairly valued today, the value of your equity will rise, which effectively means that a 40% debt ratio, because it's in market value terms, 5 years from now, might be 520 million. It's doable, but it's a little more messy because you've got to figure out how much the equity will be worth in 5 years and figure out how much debt you need. But if you have the luxury of time, you're going to be shooting for that higher debt number. So that's the question of whether you move to your optimal quickly, and if so, how to work them. Let's talk about the last piece of the financing principle. You want to make sure you issue the right kind of debt for your company. And early on in the class, I said the right kind of debt is debt that matches up to your assets. Let me back up and try to give you a very simplistic explanation for why matching debt up to your cash flows is good for you. Let's assume you have a company whose value goes up and down. Why? It's cyclical, it's commodity, so when the commodity price is high. So basically that's the value of the company. It goes up and down. If this company goes out and borrows money where the value stays the same no matter what, it's going to be in trouble. Where in this graph is the company in trouble? Is whenever the value drops below, it's technically bankrupt. You're saying, big deal, of course it's going to be bankrupt. What if I could pull off some magic and issue debt that moves up when the firm value is up, drops when the firm value is down, moves up when the firm value is up, drops? This company actually has 1.5 times more debt than the previous company, but it never goes bankrupt. The payoff to matching your debt up to your cash flows is you can borrow money and get the tax benefits without the same increase in default risk. That's a rationale for matching debt up to assets. Of course, when I do this, what have I done to my debt? I've made it behave like equity, right? Your dream financing is something that looks like debt with the tax authority. So you get the tax benefit, but behaves like equity around you. It's like a cross-dressing security. It basically plays two different roles. You get the best of both worlds. You get the flexibility of equity while getting the tax benefits of debt. So let's keep that in perspective, because over the next few pages, I'm going to try to design the perfect debt for a company. So let's say you've graduated, you're on an investment banking team or a consulting firm. I'm a company, and I've come to you for some advice on what the right kind of debt for my company is. So here are some of the questions you can ask me. First, you could ask me what the typical duration for a project is in my company. Remember that you should always ask me about my project, because I should know more about my projects than you do. So let's think about the answer to that question. If I ask this question of Boeing, what's a typical duration for a Boeing project? Probably 40, 50 years. Because you think about it, 707, 727, 737, 737 MAX, 787. No, every one of these planes, it takes about 15 years of R&D. It takes about 5 to 10 years to set up the assembly lines. And if everything goes well, they get about 25 or 30 years. The last 747 rolled off the assembly lines, I think 30 years after the first one did. So if Boeing's lucky, a typical project lasts 55 or 60 years. So help me out. Should Boeing have long-term debt? Absolutely. In fact, Boeing in the late 90s was one of two companies to issue 100-year corporate bonds. You know the other company was? Actually, Disney issued 100-year corporate bonds as well. And you're saying, what part of Disney? And you can probably answer, what part of Disney is perhaps the best candidate for 100-year bonds? The theme parks, which have a really, really long lifespan. Remember we talked about how old Disneyland is and Disney World is? So 100-year debt. In contrast, if I were Cisco and I asked you this question, what's a typical project for Cisco going to be? Probably 3 to 5 years. It's not because it's a bad company, it's a different business. Technology changes. So if you were looking at Cisco, their debt should be much more short-term than Boeing's debt, simply because of the duration of the projects. Second, I want to ask you what currency your cash flows are in. Let's return to Boeing. What currency are their cash flows in? Whatever their contract, so it depends on whether they're selling to Garuda Airlines or Singapore Airlines, their cash flows are going to reflect the currencies in which their contracts are specified. Which means when I look at Boeing's debt and I draw a pie chart of its debt, should reflect the pie chart of whatever currencies are exposed to. In contrast, if you're a company that gets all of your revenues domestically, I don't care how cheap it is to borrow elsewhere, your debt should be a domestic currency debt. Third, I'm going to ask you how inflation affects your cash flow. Sounds like a mysterious question. The question I'm really asking you is, do you have pricing power? And here's why. I mean, let's say you're in an economy where we're kind of spoiled now in the US and much of Europe, where inflation has stayed at about 2% for a long time. But let's say you're in an economy where inflation goes up and down, 7% one year, 2% the next, and 8% the third year. You're saying, why do you care about pricing? If you have pricing power, as inflation goes up and down, what do? You pass it through to your customers. You're saying, why does that matter? It's going to drive my choice of floating or fixed rate debt, and here's why. If I have floating rate debt, what's the essence of floating rate debt? The interest rate each year gets reset based on a LIBOR, prime rate, 10-year bond rate, some market set rate, right? So inflation is high, whether you like it or not, interest rates are going to be high. So if you have floating rate debt, your interest payments are going to be high when inflation is high, and they're going to be lower when inflation is lower. Do you see why pricing power is going to help you? Because if you have pricing power, then when inflation is high, you push prices up, you're able to make those floating rate payments. But if you don't have pricing power and you take on floating rate debt and inflation goes up, you're going to be squeezed, because your interest payments are going to go up, but you're not going to be able to pass that through to your customers. The choice of fixed or floating rate debt, in my view, is driven primarily by whether you have pricing power. If you have no pricing power, you have no business issuing floating rate debt, because you're going to put your company at risk. Then I'm going to ask you, are you a mature company with relatively low growth? Are you a company with potentially large growth prospects in the future? You know what choice that drives? If you're a mature company, I think you're a much better candidate for conventional debt. We just issue the debt, fixed rate debt. But if you're a growth company, you have two things going for you. One is you have growth, and the second is you have risk. Normally risk is a bad thing, but here's how you can take advantage of the fact that you're riskier. If you issue a convertible bond, a big chunk of your value comes from the conversion option. And remember, options become more valuable as risk goes up. So what you're doing is you're taking advantage of the risk that is normally a negative to raise debt using convertible debt. That way, during your growth years, when you don't have much in cash flows, your coupon payment will stay low because the convertible debt coupon will be low. And when your cash flows start to show up, the convertible debt will get converted, and you got straight debt. That's 80% of debt design. How long term, what currency, fixed or floating rate, straight or convertible. And then you can have fun. You can figure out what else affects a company and try to bring it into the debt. So let me throw a couple of examples at you. You're a gold mining company. What's the biggest factor driving your cash flows year after year? What happens to gold prices? When gold prices are high, your cash flows are high. When gold prices are low, your cash flows are low. You're thinking about issuing debt, but you're worried. Worried about what? Well, if you borrow money and gold prices drop, you could go bankrupt. Could I design a bond for you where you can borrow money and get the tax savings and still be protected if gold prices go down? What should I do to the bond? If I can tie your coupon payment to the gold price, when gold prices are high, you're willing to pay 10%. The gold prices, that'll allow you to borrow money and not be worried. In fact, the very first commodity bond was a gold-linked bond. It was issued by Sunshine Mining in the early 1980s. Now you have a whole set of commodity bonds where you can think of all these shale oil companies that borrowed money in 2013 and 14 that are now in trouble because they have too much debt. Think of how much less trouble they'd have been if they'd issued bonds that were tied to oil prices. You're saying, who would buy a bond tied? Trust me, people will buy bonds tied to pretty much anything. In fact, my favorite example is Bowie bonds. Have you heard of Bowie bonds? You've heard of David Bowie, right? The guy with the spiky hair who kind of died a couple of years ago. And so this was in the early 90s. David Bowie had a fight with his record company, and he bought back the rights to all of his music, which left him with a cash flow problem. Rock star, cash flow problem don't go together because you got 6 houses and 10 roads. You got to have the cash flows coming in. So here's what he did. He took all of his music, he bundled it and issued bonds against the revenues from the music. And what made Bowie bonds unique? It's actually an investment banker in New York who designed the bond for him. Is the coupon rate was tied to how many records. These were the days before, iTunes, how many records he sold. If you had 5 platinum records, the coupon rate actually went up to 15%. If tomorrow we all woke up and said, David Bowie, spiky hair, can't sing a lick, the coupon rate would drop to 0%. If people will buy Bowie bonds, they'll buy gold-linked bonds or oil-linked bonds. You link it to something. Everybody thinks they're an expert on something. Okay? There's actually a swimming pool company in the East Coast that issued bonds tied to the temperature, the average temperature during the summer, because they found that their revenues were closely tied, whether it's very hot summer. And there's an Italian soccer team that actually tied the coupon payments on the bonds they issued because they dropped from the first division to the second division. I don't know what they're called in the Italian league. So they tied it to whether they made it back to the first division or stayed in the second division. What you're effectively doing is trying to create a bond that looks like equity, because you get all the benefits of equity as well as the tax benefits of debt. So that's the first step, is you're trying to design the perfect bond for your company. Yes? They could, but in a sense what they're looking for is, some fixed income payment as well. So they could buy equity, they could buy options, but this gives them a very direct chance of betting on just one aspect of the equity. There's a big, In fact, one final example, somebody went through this class of probably 2 decades ago, went to work at Allstate Insurance Company. And she called me about 6 months into her job, very excited. She said, I tried your optimal capital structure spreadsheet. She put the blame on me, your optimal capital structure spreadsheet on Allstate, and they look like they're massively underlevered. And I said, what do you plan to do? She said, I plan to bring this up at the management meeting that they have too little debt. I said, okay, let me know how it goes, because I knew this was not going to go well. So she calls me a couple of weeks later for long. She says, I brought it up, and their response was, we know. We know we're underlevered. I asked her, did you ask them why they didn't borrow the extra money? And she said, their answer was very simple. We're always one catastrophe away from being in trouble. We cannot afford to go up to that debt ratio. You know what they're talking about, right? A hurricane in Florida, an earthquake in California, all of a sudden you go from being this nice, well-capitalized insurance company to one in trouble. Is there a way you could design a bond for an insurance company that lets them borrow money and not worry about the catastrophe? How would you design the bond? All you have to do is hire a couple of very clever lawyers, sit there and design a bond where your coupon payments and principal payments were tied to whether of course you'd have to have the lawyers specify what a catastrophe is. An earthquake greater than 8 on the Richter scale, a hurricane that causes more than $5 billion in damage. We will suspend coupon payments legally for 5 years and maybe even half the principal payment. You see, why would people buy that bond? Why would people buy the bond? Because the interest rate on the bond is going to be much higher. And you know what you're implicitly betting on? You read the Farmer's Almanac and it says there's not going to be a hurricane for the next 3 years, and you're trying to take advantage of the inside knowledge. I don't even call it insider knowledge, but you think it's inside knowledge. Everybody thinks they're an expert on something. And what you're taking advantage of this misplaced belief that you have an expertise in forecasting hurricanes or earthquakes. In fact, those bonds exist. They're called cat bonds. They're not issued by the big insurance companies, but small insurance companies use them to protect themselves. Of course, reinsurance is just another version of this. For the large insurance companies, that's the way they go. But some of the smaller insurance companies have actually issued bonds that allow them to be okay in the event of a catastrophe. So that's your first step. My problem often with debt design is people design debt out of cookbooks. They design debt based on what the last client wanted. Like walking into a doctor's office and the prescription they give you is a prescription of the last person's disease. If you're going to design debt, it's got to come from understanding the company. So start thinking about your company. Start thinking about what a typical project looks like for the company. For some of your companies, it's going to be easier than others, right? So if you're doing a retail store, your typical project is going to be just another store. But if you're doing a multi-business company like Disney, you can already see that different parts of Disney are going to require very different kinds of debt. In fact, start thinking about if Disney streaming were a standalone business, first, should they borrow money? And if they decide to borrow money, what type of debt should they issue, given their cash flow profile? Because that's exactly the kind of question you should ask about designing debt. Question? It is. It could be. There is a liquidity issue, which is if there's not enough liquidity. So that's why when you start designing the debt, if it turns out to be so unique that it's going to be too small a market, you might decide that you're going to issue conventional debt and create your customization using futures and options and derivatives. That's the advantage you have, right? If you cannot issue the perfect debt, you can still create something that looks like it by taking existing traded instruments out there. But let's say you're the investment banker or the consultant, and your first 5 clients, each of them you design this perfect debt, and it's not out there, but they all look like they could benefit. After the 5th client, say, why shouldn't I create a market out of this? Because some of the most lucrative inventions from investment banks have come around designing securities, mortgage-backed securities. And Lou Ranieri came along. People said, hey, who would ever buy securities issued against mortgages? So it is true, some might be so unique that you cannot create them, but if you find that need pop up 4, 5, 6 times in a row, there's a potential market there to be thought about. But you also always have that customization option of using options and futures on top of straight bonds. So first step is designing the bond that's right for your client. And that's going to be different. And that's a good thing, because if I could write an Excel spreadsheet that matches debt up, there's really no need for people. So your place here is to listen to managers tell you about their projects and design debt that's right for them. Now comes the second step. Remember what we did in step one? We created debt that looked like equity, behaved like equity, gave you the flexibility of equity. In fact, you might have been too clever for your own good. And here's why. You've designed something that looks so much like equity that the tax guy says, you know what, that's equity. In which case all your hard work is down the drain. So your second stop is to stop at the tax guy's office or the tax lawyer's office and make sure that the security you've designed is still going to pass the debt test. Okay. And this is also your last stop to see if you can add any special features, because tax code is full of these strange little quirks if you can somehow modify your bond. So what you're doing is you're massaging the bond to maximize tax benefits. So the way zero coupon bonds get taxed is a little quirky. It's not complete. It doesn't actually strike me as a sensible way of doing it. But if that's the way they're going to get taxed, you might have to readjust your debt to get the maximum tax benefits. Okay? So this is the part where you look at adding features to, I'm sorry, where did I kind of jump pages, didn't I? Yeah. You have to make sure you haven't crossed that line on the tax code. So this step, all you're doing is making sure you get the tax benefits. The third step is the tricky step where you're trying to keep three very different groups of people happy. 2 in every company and 3 in some. So let's say you're a Midwestern company. You've decided to issue some financing next week to raise $500 million. And you fly out to New York to make sure everybody's on your side. So your first stop is at the ratings agency. Now you walk into the ratings agency and you tell them you're going to raise financing next week. Remember, ratings agencies are focused on one thing and one thing alone, which is default risk. So to make you look better, what do they want you to issue? Equity or debt? You got to convince the ratings agency that what you're issuing next week is equity. You're saying, what's the big deal? Okay. So you convince the ratings agency, you leave Moody's or S&P, and you go uptown to an equity research analyst conference. So the equity research analyst conference, you're going to tell them you're going to issue $500 million new financing next week. Do the equity research analysts want you to raise debt or issue equity? And why? What happens when you issue equity? What's a bogeyman who comes out of the closet? Well, you issue shares. Shares dilute. So dilution is something they hate, so they want you to issue debt because it'll make the per share numbers look better. But remember, the same financing was equity in the morning, now magically has to become debt. You think that's a trick you can't pull off? Well, we can try. And if you're a regulated company, an insurance company, a bank, remember they measure regulatory capital using equity. It's got to go back to being equity again. Equity, debt, back to equity. This is a dance that companies dance all the time because different groups have different definitions to go by. So if you can design a security that the ratings agency treats as equity and the equity research analysts think of as debt, you create, in a sense, a dream security for your company. So I'll give you an example of a security that was created in the early 90s that seemed to fulfill this role. It's called trust preferred stock. Okay? Forget the name that I gave. I'm going to describe what the security does. And I want you to tell me, based on our earlier description of debt and equity, which bucket you would put into. Is it debt or equity? So here's what trust preferred stock looks like. It comes with a fixed dividend payment that's set up front. That fixed dividend payment is tax deductible. And if you fail to make that fixed dividend payment, you got to turn over voting rights and control of the company to the trust preferred shareholders. Fixed dividend, tax deductible, loss of control. Which bucket would you put into? Does that look more like debt or equity? That looks to me like it's debt, right? It meets all the characteristics of debt. And for whatever reason, the ratings agencies, when this was first issued, decided to treat it as equity. I talked to one of the people on the original panel that made that judgment, asked them why they did it. He gave me 2 reasons. One, incredibly stupid, and one, mildly stupid. You know what the incredibly stupid reason was? He said it was called preferred stock. That's a nice opening you've given me. I'm going to go on a naming convention on my balance sheet. I don't have bank loans. I call them bank preferred stock. That's an incredibly stupid reason to classify something just based on what it's called. And he gave the mildly stupid reason next. He said trust preferred does not come with a finite maturity. Equity is the one which lasts forever. Debt comes with a finite maturity. So if you don't have a finite maturity, we're going to treat it as equity. What's wrong with that argument? What did I say Boeing issued in the late 90s? 100-year corporate bonds. I don't know about you, but if I buy a 100-year corporate bond, I don't expect to collect the face value at the end. Maybe you're incredibly optimistic about your lifespan. So once you get 100 years, what difference does it make? You can make it 500-year bonds, 5,000-year bonds. I'm not going to get the principal anyway. In fact, the Canadian and the British governments used to issue what are called console bonds. They're still around. Console bonds come with no maturity. You basically collect coupons forever. They were issued in a more optimistic time, and forever seemed like a legitimate possibility. But if you are going to treat anything without a finite maturity as equity, you know what I'm going to advise companies to do, right? Issue console bonds. You get the tax benefits of debt, and you get the benefit of being treated as equity. It never made sense. But for 3 or 4 years, this was a loophole that companies exploited. In fact, if you worked at an investment bank in the early 90s, this was one of the most profitable securities you could underwrite, is trust preferred stock. The commissions you got were 6 to 8 times larger than what you got on straight bonds. Yep. No, I don't think so. Because in some of them, because the terms varied across trusts, they might have. In most trust preferred, you did not. It basically hung out there. So there was no conversion option, forced callability option, unlike a traditional bond. Yeah.
Which means there is always a probability of this being converted to equity at some point.
Only if you don't make the preferred do. So that's, but that's no reason to treat it as equity, right? Because you've turned over control. You've lost the equity control of the company, right?
So this is effectively giving an option, if you think about it.
Yeah, there's an option, but that option is in a sense doesn't change the basic characteristics of it being debt. That's like saying convertible. No, yeah. So it is still debt, right? So the early 90s, this became a security that was incredibly profitable. So let's say the early 90s, you went to work for an investment bank, and your job was to sell trust preferred to everybody who walked in through that door, including the UPS guy, because you made this huge commission. And you want to do the least damage you can as an investment banker. So I'm going to give you 2 groups of companies that are potential targets, and you tell me which one is a better group to sell trust preferred to, where the consequences are not going to be as dismal. The first group is a group of underlevered firms that have chosen not to go to their optimal debt ratio because they have a rating constraint. You remember we talked about rating constraints? We want to be at least AA, single A. So the first group is underlevered, but it's not used at excess debt capacity because it wants to preserve its rating. So you can get them trust preferred. And issuing trust preferred, how does that help them? Because the ratings agency treated as equity, they can preserve their rating and still get the tax benefits of debt. The second group are over-levered firms that might be able to escape ratings agencies coming down on them by issuing trust preferred. So which of the 2 groups is a better target for trust preferred, the under-levered group or the over-levered group? And you can see why, right? The under-levered group, you borrow the money, actually lower your cost of capital. The ratings agency still gives you your rating, so everybody walks away at least reasonably happy. What about the over-levered?
Over-levered cannot issue any debt.
So you would get them to issue trust preferred. You fool the ratings agency. You know only a consolation price is going to be when you go bankrupt, you're going to go bankrupt with a really good rating. Because remember, we forget, and this is actually a good point. I think we sometimes forget what the end game here is. The end game is companies need to survive, not fool the ratings agency. And they sometimes forget that. They say, if I fool the ratings agency, yes, your rating will look really good. But remember, why were they over-levered in the first place? Because they had trouble making their debt payments, right? What have I done now? Added preferred dividends on top of those. You're going to get into trouble sooner or later. In fact, that's what caused trust preferred eventually to implode. Is it a bunch of companies with good ratings that suddenly had trouble with their trust preferred? And the ratings agencies woke up and said, oh my God, this is really more like debt than equity. So what they did was actually gradual. They said initially they treated it as 100% equity, then it became 60% equity, 40% debt, then 40% equity, and finally they said, this is really debt. At which point, you know what the bankers did? They started creating new securities because what are you doing here? You're creating debt with degrees of separation from the company, right? So if you think about trust preferred as having 2 degrees of separation, if you can create something even more complex with 3 degrees, maybe the ratings agencies won't notice that you borrowed the money. And 4 degrees. And if you keep pushing this out, you know what the end game is going to look like? It's going to look like Enron. I know Enron is filled with bad people who did crazy things, but I'll wager 1998 and 99, if you walked into Enron and asked them a very simple question, how much money do you owe? They wouldn't have known the answer to the question. They'd created such good separation between themselves and their own debt that they didn't know how much. Do you think that's a problem? Not knowing how much you owe? I think it is. And eventually, that was part of what brought Enron down, is at least be aware of what you borrowed. And when you create these very, very complex securities, designed in a sense to fool ratings agencies, the ultimate problem is you might be fooling yourself. So when you create this debt decision, this is not about doing something that can get past the ratings agency. That might be one of your constraints, but your end game has to be to make sure the company survives. So let's see where we are. You've designed the perfect debt. You got the tax okay. You got these different groups, if not happy, at least not unhappy with you. Ratings agencies, equity research analysts, regulators. You get ready to issue the bonds. And you discover that nobody will buy your bonds. You're saying why? Either because you have no history in the bond market and they're worried about what you might do, or you have the wrong history in the bond market. No history is easy. The first time a company borrows in the bond market, people are always a little, even if it's a big, safe company, they worry. You're saying, what about the wrong history? Remember I talked about the Nabisco fiasco in the mid-'80s? We talked about getting Nabisco. They did leveraged buyout, took the bondholders to the... Nabisco actually went back public again. So they went private for about 5 or 6 years, then were taken public again in the early 90s. And they tried to issue bonds. And nobody would buy their bonds. And who can blame them? Because they remember the last time what happened when they bought Nabisco bonds. So if you have no history or a bad history and you try to issue bonds, even if they're perfectly designed for you, people might refuse to buy them. So you know what you'd have to do? You'll have to sugarcoat the bonds. Something to protect investors from downside risk because they're worried about you doing something stupid. So in the late 1980s, after the Nabisco fiasco, you saw special types of bonds pop up. Merrill Lynch invented these bonds called rating-sensitive bonds, where the coupon rate in the bond was tied to what your bond rating was. So if you did something like a leveraged buyout, the coupon rate would automatically adjust to protect bondholders. Convertible bonds became much more common. What's the benefit of convertible bonds? You buy those bonds and the equity investors try to rip you off too much. You know what you do? You become one of them. So who are you going to rip off now? Conversion options are actually protective devices given to bondholders so that they don't have to worry about this equity debt conflict. So you're sugarcoating the bond not because you want to. Because in a sense, you're paying a price here for sugarcoating. You're doing it because if you did not do it, the interest rate you'd have to pay on your debt would be so sky high that this is the only way you get an acceptable rate. So we're almost there. You've designed the perfect bond. You've got the tax okay. You've got these different groups at least singing the same tune. You've sugarcoated the bond. You get ready to issue the bond. One final thing to think about. Don't lock in market mistakes that work against you. Let me be more specific. Let's assume that you have a bond rating of BBB. That's what Moody's has given you. But based on your financials and based on what you know about your projects, you really think you should have a AA rating. And let's say you're right. And let's finally also assume that this company, the right kind of debt for them is 30-year fixed rate debt because they have long-term projects and they have no pricing power. You might not want to issue those 30-year bonds today. Why? Because they're going to be priced as if they're BBB bonds, and you really should be getting a AA rate. So you know what you might do? You might take on bridge financing, short-term debt, and try to talk the ratings agency. It might not always work, but try to get the ratings agency to see the error in their ways. So that's a scenario where you might defer matching up debt perfectly because you think you're being underrated. So I said, don't lock in market mistakes that work against you. What if you have market mistakes that work in your favor? You see what I'm talking about? You should really be BBB rated, but the ratings agency screwed up and given you a AA rating. What are you going to be tempted to do? Raise as much debt as you can, even though you don't need it. Lock in the rate. But I'll tell you the way this plays out is not in the bond market. I mean, right now equities are sky high, right? There are a lot of these high growth companies with stock price have quadrupled over the last 2, 3, 4 years. Let's assume that I'm the CFO of one of these companies and you've come in, you're my consultant. I call you into my office and say, come on in, I have something confidential to ask you. I close the door, I pull down the shades, and then I say, you know what? I think our stock is trading at 2 times what it should be. Okay? This is why I needed the shades down, the doors locked. And then I ask you, well, should I go out and issue as many shares as I can because I know the market is paying too much and raise, even though I don't need the money? What's your answer to that? Because this is a question that I know, especially companies whose stock price have zoomed in the last 4 or 5 years, I'm sure are asking is, hey, in fact, the Zoom, do you read the Zoom CEO? Because it went up, its pricing went up to like 16 billion. It's a company with 350 million in revenues. And the Zoom CEO came out and said, this is crazy. We're not worth 16 billion. You should never say that as a CEO in the open. But he was, I can't even believe this is happening. But if you're the Zoom CEO, you're saying, should I take advantage of markets? What do you think the answer to that is? If I have good projects, the answer is yes, because I have no choice. I have to raise capital. It's your problem. You overprice. I didn't force you. So if I have projects, I'm going to raise the equity. But what if I don't have? Should I raise much more than I need right now? Let's think through this. Let's suppose we go out and raise 5 billion. Zoom goes out and says, look, this looks good. We're going to issue another 5 billion equity. They raise the 5 billion. They don't have projects. First thing to worry about is we have a lot of cash sitting around. You're going to do stupid things. So you've got to fight that urge. But here's the other one. Let's say you were right. Your stock was overpriced by, in this case, 50%. What's going to happen eventually? Your price will drop by 50%. You think, so what? At your next annual meeting, you're going to have a lot of stockholders sitting out there saying, why did you do this to us? Because you sold them the shares. They're going to be convinced that you knew this from the beginning, which is, in fact is the truth. It's a problem that you have to think through, because I think you're going to be tempted to raise equity at a really high stock price. But those are the stockholders you'll be facing if you don't need the cash. If you need the cash, your justification is, look, we needed the cash. We had to issue at the prevailing market price. But if you don't need the cash and you're raising this equity, it sounds almost like you're setting up your own stockholders. Essentially what you're doing is transferring wealth from those stockholders who bought the shares at a really high price to the existing stockholders of the company. And that might get some pushback from investors. So that's something to factor into that final decision. Yes?
What if I buy back the stock at that time? So I have cash sitting with me. I don't have to spend that much.
If you buy back the stock at the same time, you're creating another kind of redistribution, right? Because who gets the wealth then? You're taking your existing stockholders, making them. You don't want to redistribute wealth if you can. In fact, you don't want. One thing you definitely don't want to do is make your remaining shareholders worse off, and make the people who leave the company better off, because those remaining shareholders are going to be at the annual meeting. So if you're going to make a mistake, make it the other way around, right? But buying back shares at too high a price is going to transfer wealth from the existing shareholders to those new shareholders. So, or the shareholders who sell back. So that's the 5-step process. Don't even try to read this page. I just took the previous 5 slides and saw if I could fit it all into one page. I barely could. It becomes completely unreadable. But basically it's all 5 steps listed. Start with the company, get the right kind of debt, make sure it meets the tax preferences. Now factor in what ratings agencies, equity research analysts care about. Sugarcoat the bond, and then before you issue the bond, make sure you're not locking in market mistakes that work against you. So take your company, pass it through, see if you can design the perfect debt for your company. So that gives you at least a sense qualitatively of designing debt. And I want you to focus on that part for the most part when you do your project. That's what I want you to focus on. Because I'm going to give you 3 quantitative tools for designing debt for you. And I'm also going to tell you these tools come with an incredible amount of noise. So I'm going to give you the process, but I'm also going to tell you why you might not use the tools or find them that useful for your company. The first is, as I said, do the intuitive approach. Look at the project, think about the right kind of debt, build it up. And that's going to be the basis. But I'm going to give you a way of designing debt for individual standalone projects, especially if they're big ones, and using the historical data on your company to extract what kind of debt is right for your company. So let's start with the intuitive approach, where you design debt for your company based on what kind of projects it has. I'm going to try this on Disney. When I try this on Disney, remember Disney is a big company with multiple businesses. I can't have one debt that actually fits every business. I'm going to take each business separately and design the right debt for the business. So let's start with the movie business. What's a typical movie project look like? Probably 2-3 years, unless it's a franchise, right? If it's a Star Wars franchise, even the Marvel franchise, but movies are usually. So if I were financing an individual movie, the debt should probably be short term. What currency should I issue the debt in? It depends on where the movie makes its money. Fast and Furious makes more than 50% of its revenues in Asia. Whether I like it or not, if that's a franchise I'm financing, I might use more Asian currencies to fund that project. And the nature of the movie business, it's a very heavily skewed business. There are a few really big winners and lots of losers. I mean, all those movies that come and go and you don't even notice them coming and going. You notice this? We take at the end of every summer, 10% of the movies account for 90% of the gate receipts. It's been true every summer for as long as you've tracked movies. So you have movies that are huge winners and lots of movies that are just basically losers. So you're designing debt for an individual movie, maybe not so much for a company the size of Disney, but let's say you're a company like Lionsgate that makes only one movie maybe a year. And you are designing debt, you'd make that debt short term. The currency should match where the Hunger Games makes its revenues. And if you could, you'd tie the coupon rate on the movie to how well the movie does in the box office, maybe to gate receipts. Again, it might make those bonds so unique that there might not be much liquidity, but if you are designing a perfect bond, that's what it would look like. Less critical as you have 50 movies being produced, but you can see that's what the perfect bond would look like for the movie business. For the broadcasting business, typically short term, unless you have a Game of Thrones, right? Where it's not just the 8 seasons and what comes from that, but most broadcasting shows are 3, 4, 5-year lives. At least for Disney at the time that most of its shows were still US centric, so the debt should probably be dollar debt. And finally, it's going to be driven by ratings of a different sort, which is network ratings, Nielsen ratings, how many people watch the show. So the more people who watch the show, the higher the coupon can be. So basically, again, for broadcasting, the debt is going to be short term. Theme parks, most likely to be Disney's longest term debt. And you can look at how long the theme parks are out there. Currency would be a function of where the theme park is located and where the tourists come from. And finally, if you're looking at the factors that affect, so basically if you look at theme park revenues, they're at least mildly affected by how well the movies are doing. The Avengers movie next week does really well. There's going to be a jump in attendance at Disneyland where they have the new Avengers park. But it's a mild effect. But if you're designing that, that's what you'd be looking at. And finally, consumer products and interactive, it's going to reflect the risk of those businesses, especially interactive, because with a tech company with very small cash flows, we're a standalone business. Its debt should be probably convertible debt with most of the value coming from the conversion option. Because then it looks like debt, but really it's an equity option that's being traded in the form of debt. So what I'm saying is if you take your company and you start breaking its projects down, which you should have in an earlier part of the project, we're going to ask you what kind of project do you have? We went through that process. It's a setup for this part of the project. We say, what's the right kind of debt for my company? So try this on your company. Take your company, look at what it does, and based on what you can learn about the company, try to design the perfect debt. If it's a multi-business company, try to design the perfect debt for each business. And it doesn't require a single number, it just requires intuition, common sense. So when you design it, don't even worry about can I sell this. Just design it as if you can sell the debt. And then after you've designed it, you might say, look, there's no market, it's too small, not liquid enough. And you might go for something close. but you always want to start with your perfect debt before you make that judgment. Any questions? Let's talk about designing debt for individual projects. These have to be standalone projects, big projects. You're not going to do this. Each store, you don't want to kind of carry debt on its own. But if you look at a big standalone project, and you want to design the perfect debt for the project, there might be a way you can do this that extends your capital budgeting analysis. Remember that Disney, the Rio theme park that we did, where we had the cash flows for the next 10 years and a terminal value, and we came up with the cash flows each year. Okay? We used that basically to get a present value, $3.3 billion. I could have taken those same cash flows and computed a duration for the project. Fixed income foundations, did you do project duration? It's called Macaulay duration. It's very simply what you do is you take each present value and multiply by T. So basically, the cash present value in year 1 is minus 922, multiply by 1, minus 732. So basically, you just take the present values. If you add up all those numbers, you come up with 62,355. You divide that by the net present value, you come up with a duration for this project of roughly 19 years. The 18.91 is a little bit of overkill, but it's a pretty long-term project. What does that tell me? When I issue debt on this project, that gives me a rough measure of the duration of the debt. Which means if I'm issuing in terms of maturity, that's probably going to be 30 to 35-year bonds to get a 20-year duration. And I'm probably understating this duration. Why? See this cash flow in year 10? That's really not in year 10. I took cash flows forever. So this is a really, really long-term project, and if I wanted to, I could come up with a duration for the project and say the debt for this project should roughly have the same duration. But for this to work, your projects have to be standalone. They've got to be really big. And if you can do that, you can design debt that's right for your project. So I'm going to start at least the last, the last part of the project. But in this case, the perfect theme park debt should be about 19 years in duration. Okay? And the currency and the fixed or floating rates will depend on what currency you think the cash flows will be in a Rio theme park. It might be more Latin American currencies because that's where the tourists are going to come from. Okay. And there again, you might run into a brick wall, which is nobody will lend a 19-year REI debt. You might have to come back and do dollar debt and use futures and forwards and options to get rid of the mismatch. But you're trying to design debt that's right for the project. So I'm going to at least set up the last way of designing debt. And this is a little involved. What are we trying to do? We're trying to see what causes the cash flows in a company to go up and down, because we can design debt to have the same features. We should have less risk. So perhaps there's a way in which I can look at the history of a company and pass judgment on those, the operating cash flows, the value of the company. And what I'm looking for, are there clues in why my cash flows go up and down that I can use to design my debt? So here's what the numbers look like for Disney. I had the operating income every year and the enterprise value every year. So that's a market number, that's the accounting number. And I computed the percentage changes in both. There are good years and bad years in both. What I'm trying to find are macroeconomic variables that explain why my income goes up in some years and why they go down in others, and why my value goes up and down. So I'll set up at least the 5 variables I'm going to look at when we come back on Wednesday. I'm going to look at whether Disney's value goes up and down as a function of interest rates, how it's affected by the economy by looking at the percentage change in real GDP, how it's affected by inflation, and how it's affected by exchange rates. I use what's called the weighted average dollar, which actually the Federal Reserve maintains on its on St. Louis side, which is a weighted average of the dollar against all currencies. They also have a trade-weighted dollar against the major currencies. It's just one number that tells me whether the dollar is getting stronger or weaker. And I'll give away what we're going to try to do. We're going to try to see, does Disney's value and operating income change as a function of these macroeconomic variables changing? Because if it does, maybe there are clues there that I can use to design the right kind of debt for Disney. So we'll do that on Wednesday, and that'll pretty much put financing to sleep. So now, if you get a chance, at least start thinking about the right kind of debt for your company. How do you get that for the individual project? How will you get numbers in the individual project?
That's my question.
You can just do it at the
okay.
firm-wide, maybe at the division level, if they break it down by division.
Okay.
And then you're passing judgment. If it's good at the firm, then it must be good at the individual project.
Gotcha. And then for the cash flow you use for the Disney,
Yeah.
where did you get those?
That came from when we did the capital budgeting section, when we made those assumptions about revenues and expenses.
okay.
So those are the same cash flows we used when we did the NPV for the project. Again, you can't get this from the outside.
Yeah.
So that's why the historical data approach is what you might have to end up using to do the company.
So for our project, we should just use the firm wide.
Yeah, exactly.
Thank you.
Sure. Hi, how are you?
I calculated the optimal debt ratio for my company Kroger, and I was very surprised to find that that the optimal debt ratio is way below what they have
What's your
currently,
optimal?
20, and they're at 15.
Because of the leases.
Operating leases.
A part of your debt. So that's why your debt
Yeah.
ratio is so high. So it's a very difficult trap to get out of, right?
It's very interesting because all the other indicators, when I first did the quality assessment of my intuition, I said, oh, they probably, optimal debt ratio should be high because it's not discretionary, low, bankruptcy costs, not very
But it's also-
conservative business.
You can conclude the optimal debt should be high, but if enterprise value has dropped substantially
Yeah,
because
it
people are not optimistic about the future for brick and mortar grocery stores going up against the online and the Whole Foods, your enterprise value will drop, which means the same optimal debt that 2 or 3 years ago would have given you, a 50% debt. So basically what you're finding is you cannot afford to take as much debt relative to your enterprise value as you could have 2 or 3 or 4 years ago before people turned.
But how does the model factor that in?
TDS spreadsheet, right? Enterprise value reflects what the market thinks about the company. Your the cash flows and the ratings tell you how much. So basically, what the spreadsheet does, it calculates an optimal dollar debt. That's really what the spreadsheet does. It divides it by the current enterprise value to come up with a debt ratio. So that current enterprise value is high relative to your operating income. And now what Kroger's 2018 numbers, they were lower than historical or higher than historical. So using 2018 numbers to come with the optimal dollar debt, if the enterprise value is high relative to that operating income, you're going to end up with a low optimal debt ratio. That's why all the high growth firms, even if you take the Facebooks of the world, which can borrow a lot of money, their optimal debt ratios will be low because the enterprise value is so high. So it's not a question of how much income you have, it's so compute that EBITDA to EV that we computed.
Yeah.
And my guess is you're getting a 20% debt ratio, that number is 6% or 7%. That number is 14, 15, 16%, you'd get a much higher optimal debt ratio. So check to see what their operating income looked like in 2018 because that's driving the and perhaps 2018 was a bad year and you're being a little unfair to Kroger by saying this is how much you should borrow. Maybe you need to look at an average between 2016 and 18 and maybe that'll give you a more reasonable optimal. So try that first. Now check to see whether the operating income dropped off. Because if it did drop off, your optimal is going to be low.
Yeah, and there's also it goes up very fast, the cost of capital,
Right.
once they hit a certain threshold. But that's the 30%.
That comes from the operating income as well, right? So
Yeah.
once you get to an interest coverage ratio, where you hit those inflection points, it's going to take off. So check to see whether you're being unfair to the company by using a 2018 income that might be too low, right?
Yeah.
But if it is what it is, then you can conclude that it's over-levered, which means it's one more fight that Kroger will have to fight, is how do you reduce debt ratio at a company that gets most of its debt from leases? It's not like you pay off the debt,
But
right?
it does have ROC higher than cost of capital.
So you're not under threat of distress, but you might have to decide how you get out of this problem quickly, and there's no quick way out, right?
Yeah.
You'd have to shut down your probably the Krogers they have in the highest rental areas, the highest lease areas, because that creates a disproportionate amount of debt.